Start off the presentation, disclaimer, this presentation is for education and and fun purposes only. Anything in the presentation, always talk to your provider and have it geared to your specifics. That's the tax lawyer in me. So let's just start off a little bit, right? So, a little bit about what your expectations are for 2021, a little bit about how you think about taxes. The election obviously is drives that a lot. You go back a month or two, we all thought it was going to, there was a good chance that there was going to be a Democratic sweep. So, thoughts were, what was Biden going to do if he wins the election and increase the taxes on everybody or those, high income earners. So, at this point, quite looks like, Biden will be our next president. We'll have a Democratic House, but kind of unusual since this is the year of unusual. We don't know who's going to control the Senate right now. So the Republicans have 50 seats, but there's 2 seats that will, be determined in a runoff in Georgia on January 5th. If the Democrats win both of those seats, you'll have a 50-50 tie in the Senate, and then the vice president will be the tiebreaker. So if 2 Democrats win that Georgia runoff, there is, the likelihood that then you have a Democratic-controlled Senate, and then, Biden will have a little bit more runway to do, to achieve his agenda, let's say.
So, Paul, I'm going to have to ask you what's going on down there in terms of the election process in the next year.
Yeah,
Are you a voter?
Yeah, so we've already voted. But I'm not paying attention to the media, but everything you touch has some sort of political ad associated with it.
Yeah.
I mean, whether it's any of your streaming services, everything. So, I mean, they're just inundating, but I'm trying not to pay much attention to it. So I don't know which way it's going to go, frankly.
Yep. And so, I mean, whenever you have, I guess 2 people running for, 4 people running for 2 offices. So you could have multiple, there's always a chance that, the Republicans win both, the Democrats win both, who knows, right? So you
it's not going to be split, right? It's going to be 2 one way or the other, right? So.
I mean, it's like flipping a coin in some ways, it can come out either way at this point.
Well,
so you got to plan accordingly.
If I may add, it's not exactly tax related, but my financial advisor, who's associated with LPL Financial, he's getting advice that next year is going to be a good year because of the split Congress, right?
Yep.
But and he's looking for move my portfolio all around here before year end, and I'm going to hold off until after the vote on January 5th.
Yeah, well, that's economies tend to do well, have tended to do well in the past when there has been a split. And that's all because if there's split, there's less, well, we'll get into it, there's less likelihood of legislation. So you have some certainty about what your future is. But that being said, regardless of how January 5th turns out, even if the Democrats control, both the House and the Senate, Congress has some priorities, quite frankly, ahead of taxes, right? I mean, there's, they have to get a budget approved. They have, stimulus priorities that, the economy is not in a great place, right? And we're not in a great place with the virus. So, they have other priorities ahead of taxes. And even if you look back 4 years when, the Republicans had the clean sweep, it took Trump 12 months or, the better part of 11 months to get something passed from a tax perspective, right? So that was December when the Tax Cuts and Jobs Act was passed. So, I mean, it takes some time even when you have control. So if you're someone who thinks taxes are going up because of this, well, are they going to go up this year? Or are they going to go up next year? If they're passed, the longer it takes to get passed, the less likelihood it's going to be retroactive to January 1. The fear, before the election was that Biden would become president and, increase, the tax rates on capital gains and make it all retroactive to January 1. Everybody's going to sell their, sell their gains in December, December 30th, right? So, the long story short is this split it's really up in the air, and it really, you have to make a bet about where you think things are going to go. So that's where that poll kind of comes into it. But all that being said, there are these huge deficits, right? This stimulus bill doesn't pay for itself. So if you think that taxes are going to go down or stay the same, personally, I think that's a little foolish, because somebody has to pay for it. So, there's going to be some tax increases somewhere. I think both sides, my personal view, both sides, both parties at some point somewhere have to give to pay for this. They can't kick the can down the road forever. So that's my personal view. But where does this leave us? Even with no tax legislation in 2021, we're still dealing right now in 2020 with a lot of tax legislation and changes that have occurred over the last 4 years that significantly impact your year-end taxes. So the 2017 Tax Cuts and Jobs Act, that significantly reduced taxes, but a lot of the individual tax cuts phase out after 2025. The corporate tax reductions were permanent, but a lot of those start to phase out. So they impact you currently. You need to start thinking about, as they phase out, what's going to happen. The 2019 Setting Every Community Up for Retirement Act, that tended to affect folks that are, their IRAs and they're close to that 70-year-old range. So it allowed people to kind of push off their RMDs and not take them till they're 72. It allowed people that are still working to contribute to an IRA even after they're 70 and a half. It made some changes to the kiddie tax, but it wasn't what I'll say is a all-encompassing act that kind of affected everybody. And then obviously the 2020 CARES Act, stimulus bill, right? It gave everybody, a large majority of the population stimulus checks. It had a lot of favorable tax legislation around contributions and trying to stimulate contributions and allowing people to get, I'll say, higher thresholds, and we'll get into it later on, medical deductions, contributions, and the like. So there's a lot of things going on, even if you don't think there's going to be tax legislation in 2021. So what does all this mean? You kind of put it together. All this means is you got to really, you have to do this every year regardless, but I think this year is a year that's even more important. Is, you really got to look at your own personal situation. You need to think about all these different things that are going on and the different rules and say, how do these affect me? As opposed to, I think they're going to affect everybody a little differently. And then, am I a betting person on where tax rates are going to go? And do scenario planning. What if tax rates go up? What does it mean to me? What if tax rates go down? What's it mean to me? Right? So you do some scenario planning. If you work with an advisor, they should be working with you on this. Fourth quarter estimated taxes are coming up, they're due. I don't do a ton of individual clients, but I've reached out to each one of them to do a year, even if they're on safe harbor estimated taxes where, they have a set payment due for fourth quarter. I'm working with them, getting their December projections ready so they understand, will I have a tax due come April? Will I get a refund come April? So I can do some cash flow planning, but also it helps me as their advisor to kind of talk to them, understand what's going on in their life. What have they done? What are they thinking of doing? So we can start planning. If you wait until your tax return's in hand, there's not really time to plan. So, the biggest thing you can do at this point is to start to plan. And then when you do plan, you don't just put it in a drawer and forget about it. You revisit it as things change. So don't set it and forget it. As came to my mind as I was writing this last night. That's the Ronco rotisserie oven or whatever that was at some point. So when you have a plan, you got to revisit it with your advisor, or, for you that do your own taxes, pull it out, think about it. What's changed? What's going to change in your life that may impact your taxes? Any questions so far?
I have a question.
Yeah.
I was typing it in the chat, but
See everybody.
yeah, one of the things that seems, and you mentioned it a little bit, maybe Paul did, about switching your stock account or whatever. And I'm with you on, if your money's in a 401k or whatever, you're not going to get taxed on it till you take it out. But if you have other money in a sort of a, I'm calling it cash, but it's in stocks, but
Yep.
it's regular
Invested.
investments. Yeah. Should you be taking, and if your this year has been bad financially, if clients are short or whatever, is it a good idea to try and, look at that number, whatever the number is, 140, 150, or wherever the estimated tax or whatever that's called? And should you be trying to squeak and maybe take some gains, or should you take some capital gains now in case things change? It's a two-part question. One is the tax implication of your salary, and so if you take the gains now, maybe it doesn't push you into another bracket. And the second one is, like, you said, should we be taking capital gains now just in case?
Yeah, I think from a tax perspective, and Amy, I know you're going to get into more in the finances with folks. From a tax perspective, I would, if you thought capital gains were going to go up next year, that was the thought, right? I've had huge capital gains, and I thought, like, Biden talked about, if you make it, I think it was like people over $1 million, right? So, right, that they would put their capital gains at ordinary income rates. Well, if you're in that bucket, maybe you're doing it. But if you're not in that bucket, you don't want to sell assets just to trigger a capital gain, unless you had a reason to use capital losses or some other reason. But to incur a tax liability, you would generally want to kind of keep those assets and let them keep growing.
Frank, I was going to add to that and ask, if somebody is in a partnership, for example, and the partnership, because of this year, is having a substantial loss, right? A couple of things happen, I believe, where you could take the that loss and go backwards.
Yep.
Which was something different, because in the 2017, we couldn't do that and go backwards, but we could only go forward. Here, there was a change in the CARES Act to allow us to go backwards. So to your point, Morris, if you've got a partnership, and this is for everybody, or other losses, you may be able to go back 2 years to utilize them and then go forward again. So look, and Frank, you want to talk to that, because that would be another way.
It's on another slide, but that's
Okay.
absolutely coming up.
Yep. So that's where you've got to do these scenarios, Morris. Okay, to see, okay, if I can get that, do I have to then sell to get the capital gains? And they're in different buckets, so they may not be. That's why we've got Frank.
Yeah, and that's what, and we'll get into a little bit later. That's where the projections really come into play, because everything kind of, when you're looking at, and I'm looking at somebody's tax projection, their businesses impact, everything's driven off of different thresholds, AGI thresholds and whatnot. So everything you do in kind of one aspect of your life impacts the rest of your projection. So you kind of put it holistically together and say, hey, how do I treat, this is what's going to happen. So how does this affect everything else? And then given that, what can I do in other areas to take advantage of that? Or what should I do, right? And that's where you kind of say, my business is, because you say, my business is doing this, should I do something with capital gains? Because they all kind of play off each other. So, let's get in, I'll get into here. I won't hit on everything here. This is some of the drier stuff from a tax perspective.
This is the fun stuff, Frank, come on.
This is drier. The examples are a little bit, this is, glitzier than this, but some of the things that's changed for 2020, just to make sure you're aware of them. So part of the CARES Act, a lot of people after the Tax Cuts and Jobs Act, when they increased the standard deduction, so a married couple gets 24,800 standard deduction. So a lot of people didn't itemize after that because their state tax deductions were capped at $10,000 and they didn't have enough contributions or mortgage interest to kind of get them over the standard deduction. So a lot of people didn't itemize after that, and then so the contributions didn't matter as much. Well, so part of the CARES Act is kind of to stimulate contributions and funding of contributions. Everyone who does not itemize for 2020 will get a $300 above the line charitable contribution deductions for cash to public charities. And that's one per taxpayer. So if you're married, you only get one for the couple. If you're a single person, you get the 300 yourself. But that's new this year, and so it's out there. It's not going to make you rich. You're not going to Bahamas off of it, but it's out there. But for those of you that do itemize and get your charitable contribution deductions, this is a great year to make contributions. So what they also did was they took the cap off cash contributions. So cash contributions to public charities, used to be limited at 50%. Tax Jobs Cuts Act made it 60% of your adjusted gross income. This year, you can contribute 100% of your adjusted gross income to contributions and get that full deduction. So if you are philanthropic and wish to do that, it's out there. But even if you're not, you got some leeway to kind of get a higher contribution this year. The threshold for medical deductions is 7.5% this year. It's going to go to 10% next year. So this is a good year if you do have medical expenses and you itemize. If there's something, go ahead.
Yeah, going back to your cash contributions, if you had securities, are those considered a cash contribution?
Nope, they're securities.
Okay.
But you can, so your securities are generally, and we're going to get one of the examples, it's 30% generally. But there is some discussions that you can kind of stack them. The Tax Cuts and Jobs Act kind of didn't allow you to kind of stack cash and non-cash contributions, so you kind of got limited. There is some discussion about how people are reading the CARES Act to say, for example, if you, let's say, contributed 70% in cash and 30% in securities, that you'd still get the 100%. So kind of going on there. So you got the 7.5% medical. I don't think we've got anybody in their 70s collecting their IRAs, but you did need to take a required minimum distribution for 2020. So if you're retired and taking your distributions, you didn't have to take them for 2020. As I said before, the Secure Act lets you make contributions to an IRA even if you're past 70 and a half, if you're still working. We talked a little bit earlier and can get into a little bit later about the tax impact of the stimulus funds. If you receive PPP, if you've got an EIDL loan, if you have unemployment, if you collected unemployment, that's going to be taxable for, so you need to know about that. If you didn't get the withholding taken out, to think about that for your estimated tax payments. For 2020, there's also no penalty if you took a qualified early withdrawal from a retirement plan up to $100,000. It's not something that I would advise anybody ever to start tapping into your retirement plans early, but if you need to, it's out there, and it's a lifeline if you need it. I do know somebody who tapped into it and did and whatnot. If you do that, you're allowed to spread that tax liability over 3 years, and you're allowed to make a recontribution of those funds within 3 years of the disbursement and get back your tax if you did pay the tax. So, it's flexible, it's out there if you do need it. But like I say, I always caution somebody from touching their retirement money.
I have a question, Frank,
Shoot.
on the second to last bullet. The income tax liability spread over 3 years. Is that an option or is that required? Like, could
It's
you
an
take,
option. You can pick it up all in 2020 if you want, or that you could spread it over 3 years.
and are you advising clients, like if this was a bad year for them, as it may have been for a lot of people, would you, if you have a, what do you call it? An inherited IRA where you have to take a withdrawal, but
Yep.
you don't have to this year, but maybe you take it from the one that you can't take it from this year because you can, and you leave that for another time. Would you have any thoughts about that? Does that make sense?
Well, it's hard to, I'm not following exactly.
Yeah. Okay. It's a very specific question, but
Yeah. This is where I kind of say it's scenario planning, right? So
Yep.
look at what the options are. Here's what happens if I take it, the tax on it now. Here's what happens if I spread it, and play into these other distributions that you have out there and where you think your business is going and whatnot, and say, where do I get the best tax answer, right? And where do I have the best, cash flow? I mean, think about the cash flow of those taxes. I mean, my gut is always going to tell me, hey, I want to defer that tax liability. But, given your situation, if there's losses or something else that's going to eat them up currently, go for it. But as Amy kind of mentioned, and we'll talk later, if there's losses from a business that can be carried back, you might want to leave the income for later and take the losses now. And then the last thing I'll put out there is something that might not affect everybody, but I'll throw it out there just in case it does, and you start thinking about it. Is so with the Tax Cuts and Jobs Acts, you're all pretty much aware that your state taxes are limited to $10,000 a year, which is why a lot of people can't itemize anymore. So with that, a lot of the states have been trying to do workarounds, especially the high tax states, right? New York, New Jersey, to get people deductions or to kind of work around the federal limitations. So a lot of the states have passed, I'll say, optional pass-through taxation. So if you're a partnership, normally, if you're a partnership, the partnership, let's say it makes $100 and I'm an equal partner with another person, I pick up my $50 of tax on my individual return and I pay my state taxes based off of that $50, right? If you blow those numbers up, let's say I make $200,000, I got to pay taxes on that. And I'm going to have significant tax liabilities that I pay personally, but I can only take $10,000 on my federal return. So that's not a great answer. So what some of the states have done have said, well, but if I can kind of just go on there one more second, but businesses like corporations can take an unlimited deduction on their state taxes. So what some of the states have done have gone out there and either said, if you're operating as a partnership, instead of paying the tax at the partner level, why don't you pay it at the partnership level and take the full deduction in your partnership return and flow through less income to the partners. So the partners' state tax liabilities will go down. So in effect, you will get the deduction based off of having reduced income passed through to you. What New Jersey did, I think, is a little different. I think what they did is said, well, why don't you tax the partnership, have them pay the liability, and then pass through a credit to the individual partners that they can take to reduce their state taxes at their level. So in effect, getting you to the same place, just a little different way. And there's a lot of commentary when they did this to say IRS will never allow this. It's not a mandatory tax that partnerships can elect to either be taxed this way or not. The IRS recently came out with a notice 2020-75, which basically said that they were going to issue regulations on this, and that they were in effect, fairly agreeable to the idea that a partnership could take an elective taxation at the partnership level and pass through that deduction to the partner as ordinary, as part of the ordinary income of the partnership. So that's a good answer, or at least a good indication. It didn't address exactly, I think, those of you that might be in New Jersey in partnerships, the credit scenario, but if you're in New Jersey and you operate through a partnership, you might, you want to talk to your advisor, you want to talk to somebody about this to see how it plays out. I think it's effective in New Jersey. It might be effective 1/1/20 that you can elect to be, taxed in this manner. So it's something to think about.
Is a partner, when you say a partnership, that's a separate corporate structure than, some of these others that,
Yeah, so I'd say, so it doesn't apply to sole proprietors. So if you're a sole proprietor and you file, whether you have an LLC or no LLC, and you file like a Schedule C on your 1040, it doesn't apply to them. It applies to, you can have an LLC or a partnership, but a partnership will file a separate tax return for the business. That's a Form 1065. And so if you file a separate partnership return, you operate from a tax purposes of partnership. This is something that might help you, save some state tax, or at least get some benefit for your state taxes.
Morris, you would know if you get a K1 from your company. Okay, but if it's a subchapter S,
yeah, that's us.
then that is not the same. But for companies that are, the partnership, this is
And I don't know. So because a subchapter S is a flow through, so that might be fine. Because subchapter S, from a tax perspective, is sort of like a partnership. I don't know the answer off the top of my head, but you get a K1
That's
from
correct.
a subchapter S.
Yeah, you do.
Is it a
That's right.
multi-member, like, multi-partner, multi-member subchapter S? Is it just you or other people?
Yeah, there's two of us, but
Okay, so it's,
Mhm.
I don't know the answer off the top of my head, but it's worth
okay,
a
it's
question.
worth asking.
Yeah,
Okay, thank you.
because it's the same flow through concept. All right, so let's get into a little bit, opportunities for year end 2020, what you want to be thinking about. So once again, not everything here, but I mean, as you work through your plans, as you think about where you look like you're going to end up for 2020 and where you think you're going to be for 2021 and in the future, these are generally the things that you think about, or I think about, timing of income and deductions. So what are the things you can control? What are the things you can't control? If you're a business, you can, either send your bills out in January, you can collect them earlier, you can defer some of your cash expenses to January, you can pay them earlier. If you're a business and you have large, let's say fixed asset additions, you can accelerate those additions into December and take bonus depreciation and basically expense the whole amount. There's a lot of things you can do from timing of deductions, depending on what you have, right? And this is where I kind of say everybody's a little different. In the traditional sense of planning, one would always say, hey, I want to defer my income and I want to accelerate my deductions. I want to pay later if I can. That's the traditional planning. But, kind of like Mark was saying, maybe I want to make, pick up income early. Maybe, as Morris was mentioning, maybe I want to pick up a capital gain this year because I think I'm going to be taxed higher on it next year. So that's not always the case. And so, my view is you think through those things and you make a plan based on where you think your personal tax situation is going to be going forward. Is there going to be a change in employment in you or your spouse? Is there going to be some, I'm going to inherit an IRA and I'm going to have required distributions. I'm going to, what specifically to me might make the traditional concept not be the, what I should do. I want to do something different. So to me, it's about setting a plan and doing your best to achieve a desired result. Laws might change and you can't control those, but control what you can control. Other things you kind of think about is itemized deduction planning. We'll get into an example about that in the future, but because people have higher standard deductions, you got to kind of, you might want to think about planning on being able to utilize itemized deductions as opposed to just the standard deduction. Capital gain and loss planning, as Morris was kind of, so appropriately kind of talking about, right? So you want to look at your gains and losses, where you are currently, where your portfolio is. If you have a lot of capital gains that you've already incurred, do you want to trigger some capital losses to offset those? It's kind of year end, everybody kind of calls it loss harvesting. So I can get the benefit of those. I can offset losses against capital gains. And if I have excess losses, I can offset $3,000 of that against ordinary income. You got to be careful at year end, especially when you're doing loss harvesting. If you're selling stocks that you might want to keep long term, if you sell a stock at a loss and you buy the same stock 30 days before or 30 days after, the IRS basically doesn't let you take that loss. It kind of tacks that loss onto your new shares. So you need to be aware of that. We'll talk a little bit of an example about, contributions of appreciated securities. So if you have stocks that are appreciated, maybe there's a better answer, and you're also making charitable contributions. Maybe there's a better answer than just selling them. Maybe not a great one for this year, since there's no required minimum distributions for 2020. But if you do have required minimum distributions in many years, right, rather than taking that income, that distribution into income, you can make a direct contribution from the IRA into a charity and basically not have to pick up the income. You don't get the charitable contribution, but it's an offset. So, alternatively, I would have to pick up the income, and if I didn't get the itemized deduction, I wouldn't get the contribution. So there's a better way to do it. And this is where it kind of, really comes into, if you're someone who doesn't kind of focus on this year round, that gets into the planning. Talk to your advisor. Here are some of the things I want to do, charitably wise and income wise, and here are some of the things I have coming up. Are there better ways to structure things? These aren't by any means one size fits all, and this is how it works. To kind of Mark's question before, was all these kind of fit together, and one in and of itself might be a single, but you might put 2 or 3 of these together and hit a double or triple. At year end, it's a great time to look at your withholding and estimated tax payments. If you're an employee, the Tax Cuts and Jobs Act significantly changed how the withholding works. If you didn't, fill out a new W-4 since then, you might be under withheld and owing taxes at year end. It might be a good idea to adjust your W-4 so that the taxes are withheld more akin to what you're going to owe, so you're not being surprised at year end with a tax liability.
And that's actually not a bad thing, as Frank's been saying, is all of this we're talking about for year end. You really should be looking at this all year round with your tax planner. So in June, make a note now, in June, when you've got 6 months under your belt, especially if you're married and have additional income from your spouse and things like that, you want to be looking at this all the time to make sure each of these things are happening year round, so you don't get the surprise at December 30th, or even worse, at April 15th when you're filing.
For you, those of you that have children and who have investment income, there's a term called the kiddie tax. So if I give all my investments to my children and hopefully have them trigger the income at lower tax rates, basically the tax code makes you juices up the tax on those, and doesn't let you do that. Prior to the Tax Cuts and Jobs Act, that income would be taxed at my income tax rates. The Tax Cuts and Jobs Act changed that for 2018, 2019, and said that would be taxed at estate and trust tax rates, which are significantly higher at significantly lower thresholds. Well, the Secure Act reversed that and changed the law back to such that the children are taxed at the parents' tax rates, and also gives you the opportunity so that if you did pay using the trust and estate tax rates for 2018 and 2019, you can go back and amend your returns. So if you did have children who are subject to the kiddie tax, go back, look at your returns, look at what tax rates were used. There might be an opportunity to go back and get a refund. Other things to think about: Roth IRA conversions, always something that should be looked at if you have a traditional IRA. So basically, if you're not familiar with what a Roth IRA is, in a typical IRA, you put your money in tax-free up front. You get a deduction for it, within certain thresholds. When you hit 72 now, you have to start taking that money out, and you're taxed on that as ordinary income. What a Roth IRA does is you don't get a deduction on the way in, but the money grows tax-free, and there's no required minimum distributions on the back end. So you can leave that money in, and if for whatever reasons you didn't need that money, you could pass that on to your children, in a nice vehicle, in a tax efficient way. So if you have a traditional IRA, you can convert all or part of that to a Roth IRA. You can do it all at once or over time. So there's some planning. If your Roth IRA is decreased because the value of the assets are down at year end, if you think your tax rates are going to be higher in the future, maybe you want to convert your Roth IRA now at a lower tax rate and then let it grow tax free in the future. So you have to look at, what do you think it's going to grow at? What your rates are now? What do you expect your rates to be? And will I need that money in retirement, or, is that money I intend to, make it, an estate for my children? So a lot of thoughts go into that, but it's something that you want to kind of look at if you're in that situation.
Are there any broad rules of thumb associated with that conversion?
There's no broad rules of thumb with any of this. That's what I'm trying to, if there's an underlying concept I'm trying to give you, is talk to your tax advisor. They're worth it, and you should talk to them and see them regularly, as Amy says, right? That's there's a lot of people that say, hey, every year you want to convert some and convert up to your, whatever marginal tax rate you're in. You want to convert enough to get you right to the threshold, but not put you in the next tax rate. Years ago, you could make the Roth IRA conversion and revoke them every year. They got rid of that. If you make it, you're stuck with it. All of this is somewhat betting on what I think rates are going to be in the future. What are my cash needs going to be in the future, right? If you hit the lottery tomorrow, convert the whole thing. You don't need the Roth IRA, right? So everybody's a little different. So there's really not, I would love to say this is, I don't think, I tried my best not to make taxes difficult and hard to understand, because I think the better that my clients and you all understand taxes, the better you can raise questions about, hey, how does this impact my taxes? But there really is never, ever one size fits all. This is the way to do it. Some of the other things that change. So qualified improvement property. Those of you that have businesses, either restaurant businesses or facilities where you have like leasehold improvements, restaurant improvement property. Back at the Tax Cuts and Jobs Act, 4 years ago at this point, there was a law change that kind of prior to that, leasehold improvement property, qualified leasehold improvement property was entitled to be depreciated over 15 years and allowed to have bonus depreciation. Part of the Tax Cuts and Jobs Act, the legislators just screwed up and didn't put the, as they were doing all the different revisions at year end and trying to get something passed, they missed it. They changed the name of of leasehold improvement property. They created a new classification of property, but didn't actually say that it should be 15-year property, allowable for bonus. And as a result, everybody who had this type of property had, this leasehold property had to depreciate it over 39 years for the last couple of years. And even though Congress admitted that they screwed up, the IRS said, well, you screwed up, change the law. It's taken them, 3 years till the CARES Act to actually get a law passed to change it. So if you are in this boat that you have qualified improvement property that's been depreciated over 39 years, that you put into service the last couple of years, you now can go back, amend your prior returns to either take that bonus depreciation or file an accounting method change to fix it going forward. But that's something that, in 2020 changed and you want to look at. The next one, the NOL carryback, is huge. So as Amy kind of mentioned it before, so if you, the tax prior to 2018, you could carry losses back 2 years and forward 20. With the Tax Cuts and Jobs Act, even though they reduced a lot of the tax rates, they changed the NOL rules, said you can't carry back anymore. You can only carry forward, and it's unlimited, and you can only offset 80% of your income. So they kind of, I'll say, haircut how much, the benefit of your NOLs, at least going forward. So with, the pandemic, the CARES Act changed the rules and said, if you have losses in 2018, 19, or 20, you can carry those back 5 years and there's no limitation. So if you had losses in 18 or 19 that you, have the potential to carry back, revisit that, right? If you had income in those prior years, you can go back and get cash. If you're in a loss position for 2020, you can go back. And this is where I'd say, if you're in a loss position for 2020 and you can go back, and get cash from earlier years, this is where you might want to accelerate deductions into 2020, make that loss bigger, right? You're not going to get this for your 2021 loss. So you might want to the effect that you can juice up that loss and get cash back, do it. But then you also have to look about, in those back years and what the impact of it is. To the extent you carry back the losses in prior years, does it affect other credits? Does it affect other deductions that you took? There's a ripple effect. There's never a simple answer. If you carry back losses and it affects a qualified business income deduction that you took in a prior year, does it affect, you have to look at the other things that it impacts, and does it, is it cost effective for you personally?
And Frank, does that also potentially subject you to having that year open again, so it could be audited at that point?
That year should be open. Just the amount of the refund would be open.
Okay.
And then the last bullet there, this is more of a payroll tax, but both the CARES Act and I think the Families First Act, initiated some payroll tax credits if you there was I think the employee retention payroll tax credit, that if you didn't take PPP money and you were paying employees during the shutdown, you could take a tax credit for that against your payroll taxes. And then there's also the Family First, I think it's emergency paid leave credit. So that if you had employees, and I think this also applies to self-employed individuals, if you had either you yourself personally were affected by COVID-19, like you contacted COVID-19, or if one of a family member had it and you had to take care of them, you can take a credit for I think wages paid, or I think if you're self-employed, it's based off of your income for the year, a proportion of your income, to take a tax credit. So if you were or a family member were affected, or your employees were in this situation, look into it and see if there's an opportunity to take a credit. Okay, so with that, I don't have, I'm just trying to gauge my time here. Let's go into a couple examples, and hopefully that some of this stuff will make sense. So I got a couple examples, and these are examples I tried to lay out as best as I can. These aren't, grand slam, set up this, trust and save $1 million. These are the singles and doubles that I think we all come across, and that I see taxpayers have the opportunity to take advantage of, that, in the end of the day, they save money. So the first one is, bunching of itemized deductions. You'll sometimes hear people call it stacking of itemized deductions. But as I mentioned earlier, with the Tax Cuts and Jobs Act, the standard deductions went up significantly, and because itemized deductions were limited, personal itemized, deductions were limited, the state taxes were limited. A lot of people don't itemize anymore, or don't have the opportunity to itemize. So that being said, if you plan how you make your itemized deductions, maybe you can take the itemized deduction in certain years and basically save taxes. So in this example, I spread it over 4 years, but let's say you're maximizing your state taxes at $10,000 a year. Let's say you have $7,000 in mortgage interest a year, and you generally give away $6,000, right, to charity. Your itemized deductions in that case are $23,000. The standard deduction is $24,800. So, if you do nothing, you'd say, all right, well, I get the standard deduction. I actually got $1,800 out of it. Great, I'm happy. Let's move on. But that's not necessarily maximizing what you can do. So, what the thought here is rather than taking that straight example, plan for it and bunch, what you can control. Bunch like your charitable contributions. Instead of making them $6,000 each year in that base case, which gives me, if I take the standard deduction every year for 4 years, that gives me $99,200 of deductions. But in the alternative case, if I, in 2020 and 2022, make $12,000 of deductions rather than the 6, and I don't make a contribution in the other 2 years, economically, I'm as well off a little bit. Maybe I accelerated my cash flow $6,000 more for 2 years, but economically, I've had the same outlay over the 4 years. But in the 2 years where I doubled up on my contributions, I now increased my itemized deductions $29,000 as opposed to the $24,800, and I just kept everything, the thresholds the same for each year. So in the 2 years where I made the additional contributions, I got a higher contribution or deduction on my return by that, $4,200. So over the 4 years, I've basically increased my deductions by $8,400, which at 24% is, $2,000. Not, once again, it's not a grand slam, but if there's $2,000 sitting on the ground next to me, I'm picking it up. So
And the way to do this actually is a lot of people will do a deduct, a lot of people give in December, right?
Yep.
So instead you skip that one December, you give it in January, if you're bunching for next year. So you're giving it January, December, instead of December.
Yeah, there's a couple different ways to do it. I mean, you can use a donor advised fund where you can put, and this example, you can juice it up and say, I'm going to give the whole 24 in 1 year, and you even get a better answer, right? Because you get the standard deduction in that 3rd year, where your deductions are even lower. So you can make it even, juice it up even better. But you can use a donor advised fund, make a contribution to a donor advised fund, which like the banks all have. They have a cost to them, but you can put $24,000 in a donor advised fund and basically you advise them how they want to distribute it over the 4 years. So the charities still get the money spread over 4 years, but you get the deduction up front. You can, like my college, like their year end is June 30th. So I can give them $6,000 in June and I can give them $6,000 in July. From a year over year basis, they're happy, right? I show up in the year end book every year as contributing that year, but I've put it in my tax year on 1 year. So there's ways to do it, but you got to think about it, right? You can't, go ahead, Mars.
If you don't itemize your deductions, should you be asking your tax professional for a reduction in their fee?
No, why would you do that?
Isn't it easier to do if you don't itemize?
No, I got to think, I still got to work through it. Still got to talk about it. I got to, I'm still thinking on your behalf. Yes, it's a little easier. It's a little easier.
It's a slippery slope. I didn't sell any stocks this year. I didn't take a home office deduction.
You already answered the capital gain question. Come on, Mars.
So Morris,
family to feed.
Morris, that's why they have TurboTax. Ask you all the same questions.
Okay.
Give all the same answers, and you pay a lot less money for that.
There you go. Frank doesn't agree with you.
TurboTax doesn't think.
That's artificial intelligence as opposed to real intelligence.
Yes. Doesn't think on its feet. It just does what it's supposed to do.
Thank you, Frank.
Yeah. But I mean, this is a simple way to kind of think about what multi-year planning looks like and how, like I said, this isn't some multi-billionaire setting up a trust fund or doing something to save millions of dollars. This is just, an average person saving a couple $1,000s. The next example, this is maybe goes in the Morris's, right? So this is, I kind of took this a little bit. So, and this is, I'll say, tax doesn't wag the dog, right? So look at your finances first. So, let's just assume this kind of the same example, right? But let's just assume here that I bought Tesla a year ago. Okay, a year ago it was worth $60 a share, right? When I did this example over the weekend, it was 609. It's now 644. But we want, don't sell the stock would be my suggestion. Some people would say take the profit. But long story short, let's say I go back to that same example and my college came to me and said, hey, we want to make, a 4-year pledge. It's your reunion year. We want you to make a 4 or 5 year pledge. And, I was going to give them, I'm going to give you $6,000 over 4 years, right? So I'm going to be generous, $24,000 deduction, right? Well, I can give them cash, or if I got this appreciated stock that I'm owning, right? As opposed to that I was going to sell otherwise. And that's what I'll kind of preface it. If you're going to sell it otherwise, right? It's sitting there, right? So if I have this stock that I paid $3,000 for a year ago, it's now worth $24,400. So I've got a $21,000 gain built up in that. So if I was going to sell that myself and then give the money to the school, well, I'd have a $21,000 gain at 15%. I'd owe the IRS, $3,200. So if I was going to make that contribution to the school, I'd take the remaining proceeds, right? So I'd have $21,000 left in my pocket after I paid taxes. I'd have to, pony up $2,800 to then give the school $24,000, right? In a, I'll say unplanned world, you would say, great, well, I did great on that stock investment and I was able to kind of benefit the school, good deal. I'm pretty happy with how that turned out. But alternatively, what I could have done, when I talked to my tax advisor 4 months later, that's the result. I'm out of pocket $3,000. But if I talked to my tax advisor in June or July, when Amy suggested, and I told them, hey, I'm thinking about making this contribution and I've got these stocks out here and this is how I'm going to fund it. Your tax advisor, as opposed to TurboTax, would come out to you and say, well, rather than selling that, why don't you donate the stocks to the school? They'll take that. you'll get a deduction for the fair market value of those shares. So you'll get the $24,000 deduction, and you don't have to pay capital gains tax. So now that, 2842 that you're going to be out of pocket is back in your pocket. So you can take that 2842, and your tax advisor will only take a small percentage of that, but you're better off, right? And this is where it kind of comes into, the planning, talking to your advisor. If it's somebody, if you do it yourself, just think about what are the major things in my life that are changing, that I want to do, that I want to achieve, right? And thinking about how they, what's the impact on my taxes, and then thinking about, are there alternative ways to do it? And this is where, I will put the plug in for your tax advisor, because they live and breathe this. So often I see people, they go throughout the year, and in April, there's very little that I can do to help you. Sometimes there's things you can do, but very often it's, here's what happened this year, and sometimes it's not even pieced together, right? So in this scenario, maybe a client just gave me their brokerage statement that showed they had a big capital gain, and they told me they had some contributions, right? But it's not pieced together. They just gave me some information and went on return, and then, like, here's the result. Here's what you owe as tax. Absolutely accurate. But without that discussion ahead of time that pieces it all together, there's no way to do the planning. And that's where when I kind of think about taxes, I don't think about memorizing what the threshold is for this number or that number, or it's how does it generally work, and what impacts other things, and what are the, what I'll say, hot buttons, as you're going through life, as you have changes, if you took PPP money, if you, are going to get an inheritance, or if you're going to, have, kids go to school in 5 years, have those discussions with your advisor, or if you don't use an advisor, at least think about them, and, have your discussion with a Google, right? And just, what should I be thinking about? I mean, really, what should I be thinking about to plan? And so in June and July, you can make changes that affect the rest of your year. After you do a transaction, sometimes you're stuck with it. And that takes us to the last example. So qualified business income deduction. So this is the deduction, the pass-through deduction, 20% pass-through deduction that came into play with the Tax Cuts and Jobs Act. So if you're a partnership S corp, sole proprietor, you essentially get to take a deduction for 20% of your qualified business income, right? And this phases out, I think, after 2025. But this is a case where, let's say you're doing well, you had a good year, you made $200,000 in your business, and let's say you have a spouse that works and they made $200,000, right? So you're dual income, doing pretty well. So as a couple, you made $400,000 of taxable income in the base case. You take your standard deduction of $24,800. You're going to get a deduction for $11,000 of 1/2 of your self-employment income, and that's going to. And then when you kind of, I'll say, cut through all the numbers, you're going to get a $14,000 pass-through deduction, qualified business income deduction, and leaves it with $350,000 roughly of taxable income and a $74,000 tax bill. But the qualified business income, if you're a specified service provider, has a phase out at $326,000 for married. It's half of that if you're an individual. So, and the way it works, if you're a specified service provider, so a CPA, a consultant, a lawyer, it's pretty draconian after you hit that threshold, that your income and the benefit of that deduction phases out. And I've kind of showed the phase out down there below, but of how it works, but it's pretty draconian. For every dollar you're above that 326,000 threshold, it's a significant reduction. It phases out pretty quickly. So if you're sitting in April in your tax advisor's office with your balance sheet and your income and all that kind of stuff, there's only so much you can do. But but actually, this is actually one you can do back at that point. So what's the alternative is, in this example, in that same scenario, let's say I want to reduce my taxable income under that $326,000, right? To avoid that threshold phase out. So in this example, real simple, as a self-employed individual, I can make a SEP IRA contribution. So I can make a contribution up to 20% of my income, which works out to be $37,757. If I do that, that gets me under the 326% taxable income threshold, and it lets me take a full $30,000 qualified business income deduction on my return. Now, my QBI deduction got reduced a little bit because that SEP IRA deduction reduced my qualified business income as well. So it reduced it a little bit, but still in that second example, in the alternative case, I reduced my taxes from $74,000 to $60,000. So I made $14,000. Now, 2/3 of that was because I got the deduction for the SEP IRA, right? But that's planning that you should be hopefully doing anyway, and that's setting you up for the future of having a tax advantage retirement fund. But I also increased my QBI deduction from $15,000 to $30,000. So I've got a $15,000 deduction at roughly, let's say 24%. That's $2-3 grand. Right?
Yeah, so Frank, this is almost the example from a year ago for me, and that's where my tax advisor earned his income that year.
Okay, there you go. Thanks for that plug. I'll give you $5 after this is. Yeah. So I mean, but you can make IRA contributions after year end. So this is something maybe you can do in April, but maybe there's like I said, that SEP IRA contribution reduced my QBI, so it also reduced my QBI deduction. To get a better answer here would be to let's say either have my spouse make an IRA contribution, right, to reduce taxable income outside of my business. So if my spouse made an IRA contribution, or if I took my charitable example from example number 1 and put that into here, and I reduced my instead of taking a standard deduction, I took a higher deduction based on charity, that would give me the same result, but also a higher QBI deduction. So it would actually be a better result. So like I said, there's never, hey, here's one size fits all. This is how you got to do it. It's thinking about, what levers you can pull, what levers are available to be pulled, and which ones make the best sense financially as well as tax. And so, like I said, I keep harping on it, but it's not one size fits all. It's kind of thinking it through and kind of crunching the numbers and thinking about where the thresholds are, where the phase outs are, and how this impacts you personally to say, well, what's the best option? I think that's about it for the examples. Any questions before we I think we'll go to the next breakout. Or actually, we're not going to have a breakout. We're just going to do it here. Okay. All right, Amy, you want to go to where are we at here? So well, we're not going to go to the breakout, but we're going to break it up because I know there's a lot of numbers, a lot of tax. Everybody might need 2 minutes to go do a bathroom break or a coffee reload.
We actually only have 5 minutes left.
Oh man, I talked more than I should have. All right, do you want to just hit into the last financial?
That's what I'm thinking. Yep. So we already did the poll on the expectations. Can you go to the next slide?
Yep. And
if anybody has to leave at 10, this will be real fast. Okay. And I'm going to do a plug also for CPAs who do taxes. I am a CPA. I don't do my own taxes. All right. I'm an expert in accounting and company accounting, but I'm not an expert at taxes, I work with each of my clients. I work with them as a partner with the CPA for the company so that we can implement those strategies that the CPA is suggesting. So that's my plug. Thank you, Frank. Again, you want to look at, we talked about the retirement, the SEP IRA in that example. You also want to look at your healthcare, all right, and educational, because there are various things you can do there from a personal perspective and such. If you have a flexible spending account, that one is one which is a use it or lose it. So this is one which is for children, childcare, and things like that. There's also, that's separate though from an HSA, which is a healthcare savings account. And that healthcare savings account does continue, the balances just continue and grow if you don't use them. So that one's okay. The investment portfolio, we did talk about that quite a bit. From a housekeeping perspective, look at your wills. Thank you, Paula. Look at your wills, look at your insurance. This should be done every year anyway. Situations change. All right. You may be divorced. You may be married. You may have grandkids. You may have kids. Whatever the situation, really look at those beneficiaries for your wills. And if you don't have a will, you need a will. Whoever it was, I forget his name, who was the founder of Zappos,
Yep.
died, and he did not have a will. All right. Thank you, Bob. Make sure you have a will. Make sure you have insurance. And also, if your company changes, look at your business insurance as well. You may have employees this year. You may have all contractors. Make sure from a business perspective, everything is still correct. And that was the last one.
Yeah, I think I just have one more slide to just plug there.
Yes.
We wanted to touch upon if we have Pennsylvania residents. Amy kind of mentioned this to me the other day as something that she kind of tripped upon and wasn't aware of, and
Thank you, Jerry.
Clients weren't aware of. So if you're in Pennsylvania, Pennsylvania does have what's called an educational improvement tax credit. That's a really great opportunity if you're philanthropic, or even if you're not. But I mean, what it basically, I know we're running out of time. So what it basically lets you do is kind of multiply your contributions by 10. So to give to educational or scholarship institutions, if you're a business who pays corporate income tax, or you have your own business and you pay personal income tax on that business, or if you're an individual, it has to be structured a little bit. But long story short, you can make contributions where the state will then give you a tax credit for 75% for a 1-year contribution or 90% for a 2-year contribution. So, for example, I did it with PwC, and you still kind of do it, but you can contribute as an individual to a special purpose entity. Let's say you contribute $10,000. You say, I'm going to contribute $10,000. And then the state's going to give you $9,000 back as a tax credit. So it only cost me $1,000 to give a $10,000 contribution to, in my case, my high school, right? If anybody's, I don't know if there's any Pennsylvania Catholic school kids here, but Business Leaders for Organized for Catholic Schools blocks. It's a huge organization. They're all over these credits. It's a great way to kind of give to, and I think like other educational institution, museums and whatnot, they have to be part of, if you go on to the Pennsylvania Department of Community and Economic Development website, it'll talk about this credit. It talks about which organizations are qualified under it. It is a capped credit, so you have to kind of claim it. It's like $140 million a year. But like organizations like, for example, I'll just kind of say Blocks. Blocks goes out, gets the credit approved for themselves. They organize these special purpose entities. You basically give them the money. They give you a K-1 at the end of the year that shows the credit and shows your charitable contribution. It's a great way to, I'll say relatively economically, because in my case, I gave a large contribution, but it only cost me 1/10 of it because I was going to pay the state taxes anyway. So it's a great way to I'll say steer deductions. Now, I will say that with some of those state tax workarounds, the IRS did come out and say, well, you don't, years ago when I took it, I could take the $10,000 charitable contribution deduction and take the $9,000 tax credit on my state return. You now have to reduce your charitable contribution deduction by the amount of the credit. So you get a $1,000 contribution on your federal return and you get a $9,000 credit on your state taxes. It's still, to me, if you can avail yourself of this and you have an organization that you want to contribute to, it's a no-brainer.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.